Number one, I think the answer will be, I think it's number 1A.
Right, mock 2. Question number 1, you're saying A, all 3 criteria must be present. Right, question, let me try to zoom it. 1, 2, like this. Right, the question, guys, I hope you're all there using BPP revision kit, right? Mock number 2. Number 1, they are saying, in accordance with IS 37, provisions, contingents, liabilities, and contingent assets, which of the following criteria must be present in order for a company to recognize the provision? What did we say on provision? What is a provision? We said that a provision is a liability of uncertain timing or what? Or amount. So now we do have different types of provision. So in this question, they are saying which of the following is correct. Yes, you said all 3 statements are right? So like the first one, there is a present obligation as the result of what? Past events. Yes, so this is correct. Some of the questions they were saying as a result of future events. It's not the future events, we are looking at what has happened before. Now we have a provision. Remember, I gave you examples of provision. We have environmental provision. This one is mostly likely to be incurred by mining companies where they will damage the environment and they are required to restore the place. So they will incur the restoration cost or say cleanup costs, dismantling costs. Right. So it's because of what is occurred already. So we are looking at the actions, we are looking at the events. So number 1 is correct. No, number 2, yes, it has to be probable that economic benefits will be required to settle the what? That a transfer of economic benefits will be required to settle the obligation, right? So yes, it has to be probable that there will be outflow. You understand? Yes, that's what we said. What about if it's not probable? Remember the word probable, we said, when we say probable, we are saying the probability is very what? High. And when you look at the percentage, it has to exceed 50%. So yes, that makes it a provision. What about if they had said it is possible? If it's possible that there will be outflow, do we call it a provision? We don't call it a provision, we call it what? A contingent liability. You still remember? Yes. Then number 3, a reliable estimate of the obligation can be made. Yes, you must be able to estimate that the cost that you can incur. For example, another example of provision is warranty provision. Remember, a company selling products with warranty, you might not know the actual cost that you incur, like when people return goods that have fault. So the issue is you work on estimate so that you'll be able to recognize that amount in the financial statements. But if you can't estimate, if you can't measure the cost reliably, therefore it's not a provision. You understand? So you should be able to measure the cost incurred, and if it's probable, yes, and as a result of past events, therefore it's a provision because it's a liability of uncertain timing or amount. Next question, number 2. Which of the following types of error is never indicated when a trial balance is extracted? Right, so guys, the error of omission, principal, and transposition error. They are saying which types of error is never indicated when a trial balance is what? Extracted. When you extract a trial balance, like the error that is never indicated, remember, omission is not recorded at all. You have not recorded anything in the trial balance, right? Transposition error, it can be two-sided. You can make that error on one side or on both sides. You remember this, like the debit and the credit. Transposition, for example, you wanted to record 1432, but you have recorded what? Are you seeing this? This is the error of what? Transposition, position of figures. 4, 3 here, you did put 3, 4, 3, 4. Understand? So maybe you can record 1342 on both sides. Or someone might record 1432 correctly, but the error is on one side. You understand? So transposition error, it can affect or it cannot affect, depending on the journal entry that is prepared, whether it's affecting both sides. What about the area of commission? Guys, follow your pearls. Follow your pearls. The area of commission, we said the transaction has been recorded correctly in the books of accounts, but in the wrong account. The class is the same. If we talk about commission, area of commission, the class is the same, but the account is wrong. For example, on expenses, both we have two costs here. Let's say A and okay, let me just give examples: rent and electricity. Right? Imagine you wanted to record 1,000 as a rent, but it was recorded in electricity account. But they are all what? Expenses, right? That's an area of what? That's an area of commission. So the class is the same, right? The class is the same. You write electricity instead of rent or vice versa. And if it's principal, we say this is when you break the principal rule. You understand? Yes, for example, treating any revenue expenditure as a capital expenditure. You have treated an expense as an asset. You understand? That's area of what? Of principle. So like for example, you're supposed to recognize as an asset, but you treat it as in what? Expenses. This is area of principle, right? For example, purchases, you purchase the motor vehicle, then it was recorded in purchases. So if a motor vehicle is an asset, right? If you acquire a motor vehicle, it must be recorded as an asset. But we are saying that cost, you just saw the word purchase of motor vehicle. Maybe you are dealing with two main transactions. So you just see the word purchase, then you think that these are purchases. That's wrong because it's an asset, motor vehicle is an asset. So this is an area of principle. So treating purchases treating assets as purchases, or maybe capitalizing expense that should be expense, or vice versa. So that's the area of principle, and when this type of error occurs, the trial balance will never be indicated, right? So the error will never be indicated in the trial balance. Let's look at number 3. Number 3, this is consolidation, guys. M owns 55% of ordinary shares. Now this is a trick in the exam. I want you to understand this. In the final exam, guys, you will be given theory questions on consolidation, or even multiple choice questions on consolidation. When they say that A owns 55, the question is N versus M. So N is N a parent of M. M acquired what percent? 55% of M. So is N the parent? Guys, this is the first thing that guys, these are the easiest questions. I'm saying, is N the parent? Well, when do we consolidate? We said that consolidation, what does it mean? Means adding together, right? This is when you consolidate, when you combine different when you combine financial statements of different companies. So they're saying N acquired 55%. Then I'm saying N, how about the relationship of M and N? Is it the parent and subsidiary relationship or is not?
It's the parent and subsidiary.
Yes, why?
Because it's more than 50%.
Because it's more than 50. I'm asking a simple question, guys. It's more than 50%. Guys, if you fail to get this right, how about the calculations? You acquire more than 50, then you are the parent. Then this is the what? Subsidiary. Right. This is the subsidiary. So when we have the parent and subsidiary, what do we do? Parent will prepare their financial statements. Subsidiary is a financial statement, like profit or loss financial position, profit or loss financial position. Now when we combine the two, we are saying we are consolidating. So this is consolidation for what? Group accounts. We will prepare the financial statements of the group. You have acquired 55%. My question was, in the exam, the question can be tricky. They will say M acquired 50, or let's say N acquired 75% of N, the 75% acquired the preference shares. Right, here's the question. Is N the parent? N acquired 75% preference shares. Will you be the parent of M?
Preference shares are not for premium.
Yes. So if it's preference shares, therefore, we don't consolidate. You understand? So therefore, N cannot be a parent. You understand? So when we say you acquire shares, you have to acquire what? The ordinary what? The ordinary shares. So let's look at the question. They are saying N owns 55% of the ordinary shares. So since they've said that these are the ordinary shares, you are becoming a permanent owner. So you be the parent and M will be the what? The subsidiary. Then they are saying what is the correct accounting treatment of the revenues and cost of M in the consolidated. So they are asking about the revenues and the cost. Guys, this question is easy because you are not doing calculations. So if it's revenue and cost, first thing you have to ask yourself, where do we recognize revenue and cost? They are recorded in which statement? In which financial statements? Where do we recognize revenue, guys? Revenue. Revenue, these are sales. So you want us to recognize sales in financial position. So where do we recognize them? Guys, this is easy. Profit or loss? Profit or loss, we recognize revenue. We recognize what? Cost. So what do? You remember what we did? We said if it's consolidation, we consolidate the amounts of the parent and what? Subsidiary. Parent plus sub. Parent plus subsidiary. But if they sold the goods to each other, we eliminate the internal what? Transaction. Remember I said we eliminate the intragroup. We eliminate the intragroup. You remember? Right. So they are saying what is the correct accounting treatment? Let's read the notes. So A, the revenues and costs of M are added to the revenues and cost of N. Is it correct? Look at what I did here. The revenues of P plus the revenue of what? Of S, the subsidiary. So statement A is correct, right? Let's prove that B is wrong. B, they're saying 55% of profit after tax should be added. That's wrong, never do that. 55%, no. B, C, D is wrong. Guys, when you acquire 50%, it doesn't mean when you consolidate, you multiply by 55%. Yes, yes, we acquired 55, but on consolidation, it doesn't mean when we consolidate, we are taking the 55%. If you acquire more than half, doesn't matter 55, 70, 80 or what. You just consolidate the amounts of the parent and the subsidiary. So A is the correct answer, right? Number 4, bank reconciliation. One of the easiest. Yes, this is a topic, guys, number 4. Right. Remember what I told you on bank reconciliation. I said the tricky part is what? What do you do first before you start calculating? Look at your opening balance. If they mention the word statement, the bank statement, it means you open the bank reconciliation. Right? Remember you have your cash book and your bank reconciliation, right? So they're saying your cash book at 3rd April 2008 shows a balance at the what? At the bank. So your cash book shows the balance. Remember when you open our cash book, the balance is representing the money that is in the bank. So they are saying your cash book shows, meaning this is the cash book account. So I'm not going to open the bank reconciliation. Remember I said you only open it when you are given the balance as per bank statement, right? So they are saying your cash book. So allow me to prepare the cash book account. CR and what? DR. If we have the cash, I will recognize the cash on which side? On the debit side, right? But if we have a liability which is an overdraft, it will be recognized on the credit side. Looking at this, they are saying the balance at the bank is 2490. They didn't say it's an overdraft. So it will be on the debit side, 2490. Right? Then you look at the information, comparison with the bank statement at the same time reviews the following differences. It doesn't mean that when you are given all the information, you have to account everything. Ask yourself a question like the first one, unpresented. Is it recorded in the cash book? Unpresented, we don't know. Why do you recognize unpresented checks? Guys, the unpresented checks, the bank lodgements or the deposits are recorded in the bank what statement. So in the cash book, we record, I'm seeing the bank charges and the dishonored checks. They reduce our cash balance. So these are the bank charges, or in the exam, they will say the bank interest. So I'm recording it on the opposite side of the BD because we are reducing the balance, right? And what else do we have? Okay, the bank charges is how much? The bank charges is 40, 50. We also have the dishonored checks of how much? Yes. Guys, I said the dishonored check, they are recorded on the credit side of cash book. Because normally what had happened before is the customer would have contacted us saying that he made or she made a payment, right? Then obviously you exclude that person from the list of debtors. But when we discover that the check was not received, it was dishonored, then we need to reduce our cash balance because it was not an inflow. When the customer says they paid by check, when they say we are paying you by check, we paid by check, what do? We eliminate them from the receivables. Then we increase our cash balance, right? But when we discover that the check was now dishonored, therefore we haven't received anything, then we will reduce the cash book account. We close off, calculate the balance CD, 2490. The shortfall here is on the credit side. So what is the balance? Sorry? 2.3. So we have deducted already. So 2.3 here, 2.3 here. Right. Let's look at the solution. Oh, it's okay. You are not given A, B, C, D. Alright, that's what they give the exam, the objective test questions. When you're given questions like this, guys, when you're given a question like this, please, I would advise you to even to recalculate. Because if you get the wrong answer, you won't be able to see whether you've made it right or wrong. But just imagine if it's A, B, C, D. If you didn't calculate well or you made a mistake when you were adding, you can easily see. Maybe you may not see it on multiple choice. Then you start again. You recalculate, right? So, but if it's this, I would advise you to do even twice to confirm that you did calculate it correctly, right? So that's it. So you're saying 2.3 is the answer. Then that's fine. Let's move on to the next question. Number 5. What should be the cost of the machine in the company's financial position? Right. They are saying W sales tax registered trader bought a new printing machine. The cost of the machine was how much? 80,000, excluding sales tax at 17.5. Then they are saying the delivery costs were 2,000 and the installation costs were 5,000. Before using the machine to print customers' orders, the test was undertaken and the paper and ink did cost you 1,000. What should be the cost of the machine? Now we are now applying the IS16 PPE, where we say we are valuing the asset. So you have to add all the costs that you have incurred before the asset is ready for intended use. We include them. So guys, those costs we say we capitalize them. We capitalize the cost that you incur right before you use the asset, right? So we want to look at the value of the machine. Is it worth 80,000? All costs incurred in bringing the asset to working condition, they are capitalized. What do we mean if we say capitalize? When we say we are capitalizing, we are including in the financial position under non-current assets. You understand? All right. So we want to add all the costs that we have incurred. Right? Let's value the machine. Let's value our machine. What will be the value? We have the purchase price, right? of how much? 80,000. Then they are saying it's excluding sales tax. Yes, it has to exclude sales tax. Right? What about the delivery cost? You acquired the machine, then they want you to you also incur the delivery cost. Because you need the machine at your working place. So you incur the transport cost or the initial delivery cost. So it should be included, right? Initial delivery cost is how much? 2,000. How about the installation? Do we include the installation? Yes, because the asset is not yet ready for use, so they have to install. So we also incur the installation what? Cost of how much? 5,000. Of 5,000, right? Then they are saying before using the machine to print customer orders, a test was undertaken and the paper and the ink cost 1,000. Do we include the 1,000? Guys, do we include the 1,000? Jora, you want to try? You can try. Jonathan, do we include 1,000? Yeah, guys should be participating. So 1,000, you're saying what? It's a testing what? Cost. Testing cost is 1,000. Because they want to test whether it's now working properly. Understand? So we're saying all the costs that you incur before the asset is ready for use, they must be included. Because when we say let's test it first, it means it's not yet ready. So therefore it's part of the cost of the asset. So in the financial position, statement of financial position, the value of the asset will say is worth how much? 88. After you give value, when we say depreciate the asset every year, the depreciation will be based on this 59% times the cost of this times 8,000. So meaning our machine is worth 88,000. You remember this?
What if the company will take the register?
You just take the 80,000. You understand? In your exam, it won't be difficult. Some of the concepts that you want to ask, we do them when we are doing SBR professionals. Where we say, they will tell you that the sales tax, it is irrecoverable or is recoverable. So when the sales tax is recoverable, it's not a what? A cost to you. Because you are going to recover your money. You understand? But when we say the sales tax is irrecoverable, you are not going to recover it, you suffered the tax. Like what you're saying, what if it was not a what? It was not registered. They will suffer tax. So we include that tax. You understand? But in the FA exam, they won't ask questions that relate to the recoverable what? Alright, so let's move on to the next question. Number 6. Which of the following correctly defines equity, guys? This is easy. Equity. What is equity? Okay, let me just help you guys. Tipping off assets is close to what? Capital plus liabilities. You understand? That's the accounting equation, right? But now this is the equation of we use this equation when we deal with sole traders, right? When it's a company, I don't just use the word capital, I will use the word what? Equity. You follow? So we are saying assets is close to equity plus liabilities, right? So now, how do you get equity? This crosses to the other side. We want to make the equity the subject of the formula, right? So we are saying assets less liabilities, you get your what? Your equity. So what is equity? We are saying assets less liabilities. Or we are saying, are you seeing these assets less liabilities? And mostly the assets will be greater than the liabilities. So if assets exceeds the liabilities, we are talking sort of we are talking about the residual what? interest. You understand? So can we read the definition? I need the one which says the residual interest in the assets. A, B, C, D, which is the correct answer. Okay, let's read everything. A, they are saying equity is a present obligation of an entity arising from past events. The settlement, if we say we have a present obligation, it means we have a what? A liability. So A, that definition is for the liabilities. What about B? Is a resource controlled by an entity as a result of past events and from which future economic benefits are expected to flow into the entity. If we say benefits will flow into the entity, if you are talking about the resources that you control, the resources that gives you benefits, it's a what? This definition is for asset, right? So the correct answer is what? C, residual interest. You understand? Number 7. Number 7. Alright. Number 7, guys, you are the one who is going to give me the correct answer there. Do you know the qualitative characteristics of financial information? Guys, if we covered that one, it's theory. If we covered the qualitative characteristics, you are not so sure?
No, we did it.
Do you want to confirm that we did the qualitative?
No, we did it. We did it.
You said what?
No, we did it.
We didn't cover that one.
No.
Alright, so it doesn't take more than 4 minutes to cover that one. So let's look at the qualitative characteristics. Guys, I want you to understand this. It's called qualitative characteristics, right? Qualitative characteristics of what? Qualitative characteristics of financial information. Yes, sir. Qualitative characteristics of financial information. Do you understand when I say this? Right. Okay, let me just write it in full so that others will be able to see clearly. Qualitative characteristics of financial information. Right. The information that we need is accountants. Okay? We need information that is relevant. I'm going to explain everything. So guys, I want you to understand this. We have what we call the fundamentals. Do you follow? On the fundamentals, we only have 2. Number 1, we have relevance, e.g., materiality. Number 2, we have what? We have faithful representation. We have 3 things here on faithful representation: complete, neutral, and free from errors. Then we have what we call the enhancing. On enhancing, we have only 4. And this is the mnemonic that I use. To CV. There are no jobs in Zimbabwe, so we need to apply CVs. To CV. Right. Timeliness. Understandability. Comparability. Verifiability. Right. I want to explain the qualitative after this, then you give me the right answer, right? Right. Are you done copying? Can you copy, guys? Qualitative qualitative characteristics of financial information we are saying. Number one, we have the fundamentals, right? The fundamentals, we only have two. Qualitative characteristic of financial information. We are talking about the information that you use to prepare what? The financial statements. So the information that we need, number one, we need you to give us the information that is what? Relevant. So we are looking at the relevance. The information that you provide, it has to be relevant. When we talk about relevant, we are talking about the value. You understand? That's why I gave you an example of materiality. Materiality, we say, what do we mean if we say this information is material? It means it has value. You understand? So you're saying materiality, you're talking about something that has a significant value. Do you understand? But that materiality is just a matter of professional judgment. And give an example. Imagine you lost 100 bond. Can you tell people that today is the bad day? Because of 100 bond, you understand? 100 TGs. Will you be stressed the whole day? Why? Because it's immaterial. Do you understand? How about if you lost 100 USD? Yes, guys, that man who agree that it has a significant value, right? So therefore, that money is material. You understand? So we are saying when you give us the information that is relevant, we are looking at the materiality. How do you know that this was material to the shareholders? How do you know that it was immaterial to the users of the information? If it affects their decision, therefore it is of relevance, right? Number two, what do we have? Faithful what? Representation, right? There are three things that you look at if you want to understand or if you want to know that the information is being faithfully represented. Number one, it has to be complete. On faithful representation, we are saying when you prepare the financial statements, make sure that the information is what? Number one, is complete. You understand? It has to be complete. Guys, you don't want people who manipulate the financial statements. Or some, they won't show everything in the books. Maybe they are understating their liabilities. You understand? So we are saying, give us information that is complete. When you ask someone that, tell me more about yourself, you see that everyone is a good person. You understand what I'm saying? Why? Because they won't give you complete information. Do you understand what I'm saying? So in the books, they're saying, give us the information that is complete. Number two, we need information that is what? We are on faithful representation. We need information that is neutral. Like that is without bias. And number three, that is free from errors. When you get that information, you say they faithfully represented the information. Those are the fundamentals. Then on the enhancing now, the information that we need, number one, timeliness. It has to be available on time. And number two, it has to be understandable, right? Number three, the information that we need, we should also be able to do a comparison. We are looking at the comparability. So on comparability, you are able to do this when you are consistent in what you are doing. For example, a company is depreciating assets using straight line method, right? You don't just move from straight line to the next year. You're saying we are no longer using straight line, we are using reducing a balancing method. So it will be difficult for us to then compare. You understand? We need consistency for comparability to work. Then verifiability. The information that you present, it has to be independently verified. So in the exam, if they say which of the following is true, which of the following are the characteristics of qualitative, just know we have how many? 6. You understand? We have 6. 2 here, 1, 2, 3, 4, 5, 6. You follow? But if they say, give us the enhancing, you exclude this. Enhancing, give them 4. You follow? Right, let's look at the question. Which of the following is a qualitative characteristics of financial information included? The correct answer is what? A, relevance, right?
But
materiality. Materiality is not a qualitative characteristic, it's an example of relevance. You understand? Number 8. Seeing IS2 guys inventory valuation. This is primary school stuff. Inventory. We all know that inventory is valued at the lower of what? Of cost and NRV, right? How many products do we have? We have 3 products, right? So I have products here. The standards are, okay, how many products? Basic. Okay, we have 3 products, right? What do we look at? When valuing inventory, we compare the what? The cost and what, guys? Guys, this primary school stuff, we compare the cost and the NRV, right? How about the cost? Original cost 10,920. 10,920. Just know that this is per unit, right? What about the NRV? Look at the question. NRV. How do you get the NRV when you're not given? NRV means what? Net realizable value, or we say net what? Selling price. So we are saying selling price less the selling cost, right? If we had repair cost, you also remove the repair cost. So what would be the NRV? 9 minus 1. Guys, we did the exact question like this even in the BPP kit, if you remember, if you practice. So 8 here, NRV 8. I'm saying selling price less the selling cost. 9 less 1, 12 less 4, 26 less 5, you get what? On 26 less 5, what do you get? 21. Right? So I now have my NRV, the cost was given. So you take the what? The lower. If you check in your books, there's an exact question like this. You take the lower, so it's just a matter of practicing. Cost versus NRV, we take the lower. So which one is lower? 8, the lower 8, the lower 20, you understand? But these are the costs per what? Per unit, you follow. So you then now multiply by the number of units. So for B, how many units do we have? 500 units, that's what we want. 1215 for S, then 815 for L. You then get your total value. You then get total 8 multiplied by, what do you get if you do the number crunching, guys? 4,000 here, 10,000 here, 17,000 here, 31,000 here. That's your answer. That's the solution. Number 9, what is the profit or loss on disposal? I always tell you guys that when you are given a question, especially the non-current assets, guys, on the non-current assets, make sure you pay attention to the dates. They are very important, the dates. So reading the question, a car was purchased in the business in May 2001. The cost of the asset is 10,000. Road fund license is 150. The total is 10,150. So guys, I have a question. What is the cost of the asset? The total cost is it 10,000 or 10,150? What is the cost of the asset? 10,000, right? Because guys, road license is not capitalized. It's not part of the cost of the asset. But maybe if it was the number plate, we were going to capitalize the number plate, right? But road license is not capitalized. So the total cost of the asset is 10. The 150 is an expense. Do you follow? So the cost of the asset is 10,000. So let's do this. The question says what? Calculate the profit or loss on disposal. So guys, when you calculate the profit or loss on disposal, you compare two things. like the money that you have received, like when you sell, which are your sell what? Proceeds. Versus what? You compare sell proceeds versus what, guys? Thank you, versus carrying. You can't compare with the costs. You understand? Someone has a new laptop costing 1,000. Then use it for 2 years. After 2 years, when you sell it at 600, you can't say I have made a loss of 100 because it was no longer worth 1,000. It has depreciated. So you compare with the remaining value of the asset, which is the carrying amount. How do you get the carrying amount? Costs less what? Yes, thank you. Carrying amount, we say costs less accumulated depreciation. Right, then you see whether, when you compare, you see whether I made a profit or what, a loss, right? Let's read the question. The business adopts a date on 31 December as its year end. So the year end is 31 December. So when you prepare the timeline, make sure your year end is 31 December. They've highlighted that. So guys, I want you to understand this. The tricky part is on getting the accumulated depreciation. If you get the accumulated depreciation, then you get it right. You understand? The car was traded in for a replacement vehicle at an agreed value of 5,000. So guys, like we are trading assets, right? So like we are not receiving money like as the sales, right? We have the sale proceeds, or we call it the what? Trade in value. You are exchanging assets, guys. The assets, we want to know the carrying value of our assets. Then they are saying they are giving us an asset that is worth how much? 5,000. What about our assets? What about the value of our assets? Let's look at the question. It has been depreciated at 25% per annum using reducing balancing method, comma, charging what? Now I want you to pay attention to this. They are charging full year depreciation in the year of purchase and none in the year of what? Sale. So it's about the dates. Guys, what is our year end? We are calculating the profit or loss on disposal on which day? Or like the current year is what? December 2004. You understand? So the year end is 31 December 2004. The asset was purchased when? May 2001. So on this case now, we don't just say 2001 less 2004, then you get the number of years. That the asset has been used. So guys, you can't do that. Why? Because we are saying we are charging a full year depreciation in the year of what? Purchase and none in the year of disposal. So guys, this is what you do. So I have my timeline like the current. Allow me to start with the current year. The current year is December 2004. If the year ends here, it means it commences on 1 January 2004. Can you see this? But we acquired the asset when? Yes, 2001. So I need even the timeline for the previous years. So allow me to do that, guys. This is for 31 December 2003. 31 December 2002. 31 December 2001. So I'll end it here, right? Guys, this is January, like this. Can you see this? I now have 4 timelines. Where did we acquire the assets? In the month of what? May. Right? 2001, right? Then they are saying on the year that you acquired, they said you are charging what? Full depreciation in the year that we acquired. This is the year that we acquired. So we are charging full depreciation. You agree with me? It doesn't matter you acquired it on May. It doesn't matter like we were left with few months. On this case, they didn't say do pro rata basis, where you say depreciation per year times the number of months here. So they are saying even if you're left with 5 days, they are saying charge full depreciation. So here I'm charging full depreciation, which is 25% multiplied by the value of the asset, which is 10,000. What will be the depreciation? 25% of 10,000 is 2.5, right? The depreciation is 2.5. What about this one? Obviously, this one is clear. You charge full year, right? But it's not straight line. If it was straight line method, I was going to put even 2.5 here, 2.5. Because straight line, the depreciation is the same, doesn't change every year. But the reducing balance, it changes. So we have what, 25% multiplied by, guys, we all know reducing, you multiply by the carrying amount. What is the carrying amount now? When it was new, we said the value is 10,000. But it is depreciated by what? 2.5. Meaning the carrying amount is how much? 7.5. Then I will put equal sign, 25% and CA representing carrying amount of 7.5. What do you get? I'm getting 18 what? 75 is my depreciation. How about this here? 25% times carrying amount. What's your carrying amount now? Remember, the remaining was now 7.5. Then we got the depreciation of this. So what is the remaining now?
5625.
Sorry?
5625.
56225. That's the carrying amount. So the depreciation for this year, should multiply. $14.06, right? Is that what you're getting? Yes, if you round off, that's 1406, right? What about in the current year, the depreciation? Can you read your question? And none in the year of sale. Because they traded it on which day? August 2004, August, yeah. That's when they traded or they sold. But they said depreciation, you charge what? None. So this year we're not charging depreciation. So like, let's look at the total depreciation of the asset. Now I'm now getting my carrying amount here. The cost of the asset when it was new, we said is 10,000, right? Less the depreciation in total, like the accumulated. It is depreciated by this amount, and this. So let's sum up. 2.5 plus 1875 plus 1406. I'm getting 5781. All right. Let me show you. We want to calculate. I'm getting what? 10,000 less 5781. I'm getting 4219. So the value of our assets, it was worth 4219. But when we traded, the value was worth 5,000. So guys, are you seeing that we gained? There's a gain of 785, which is the profit. Then B is the correct answer. Are you seeing the non-current assets? So prepare your timeline. You started the current timeline. Then you the ratio I'm charging here. Here they say charge full. Obviously full year. Then they say charge none. So you have the accumulated. That's why I've said that the tricky part is on getting the accumulated depreciation. Like when you're given a non-current assets question, what to do first? Calculate the depreciation per year. multiply by the number of years, you get the accumulated. They need to be easy to get the carrying amount. You follow, right? Yes. Alright, number 10. Guys, the allowance, we all know the allowances, right? Allowance for receivables and irrecoverable debts. When we deal with the irrecoverable debt is the amount that you are now certain that you won't be able to recover. So irrecoverable debt, we treat it as an expense, right? But if it's the allowance you are expecting that they won't be able to pay. So on the allowance, these are just expectation. When you increase allowances, it means customers are not paying as expected. So therefore an increase in allowance is an expense. But when you reduce the allowances, it will be an income, right? So I'll start by calculating the allowances first. Allowance BD for the last year. Allowance for receivable BD. They are saying at 1 January 2003, A had an allowance of, the allowance was 35,000. What about the allowance for this year? The allowance CD. Is it given? At 2003, the trade receivables were 620. It was decided to write off the debts. Those are the irrecoverable debts, which is 10,000. And the second point, adjust the allowance to an amount equivalent of what? So you have not been given the allowance for this year. They are saying it's 5% multiplied by what? By the receivables. You follow? Mm-hmm. Yes, so we are multiplying by the receivables. But guys, I want you to understand this. What is the amount for the receivable? Is 620,000, right? The question is, do you expect to collect the whole 620,000 from customers? Are we still expecting to get this 620? Do you still expect to recover the whole amount, 620? Why? Because they're saying it was decided to what? To write off receivables of 30,000. Meaning that to write off is to treat as an expense. It's an irrecoverable debt. So yes, we have 620, but we are now certain that 30,000 will not be recovered. So therefore, in the books, we consider the recoverable receivables, the amount that you expect to recover from customers. So guys, we have our 620. So we have to remove 30,000 first because it's no longer recoverable. So then you say 5% multiplied by your receivables. So 5% of 590, right? 29,500. Our allowance is what? Decreased, right? Decrease in allowance. Decrease in allowance is how much? 35 less 29,500. 5.5 and it's an income. So now I want to prepare the profit or loss extract. Do we have an income? When I say an extract, I'm not preparing the whole profit or loss. We are focusing on the income and expense. So we are saying allowance BD 35, allowance BD 29. There's a decrease in allowance, and a decrease in allowance, it's an income. Right, so here profit or loss extract, do we have incomes? We have an income. Yes, so I will record this as an income as a decrease in allowance, right? 5,500. What about the expenses?
Yes, 30,000.
Yes. They have said that they are writing off the 30,000. To write off, they are treating it as an irrecoverable debt. So irrecoverable debt, guys, is an expense. Then you have 30,000. So what's important on this question is to know that are we going to get 35,500 or less than that? So you can't add, you can't say 5.5 plus 30 because the other one is an income, the other one is what? It's an expense. So you have to net off. You net off and you get 24 what? You get 24,500. This is my net expense. 24,500. You're on number 10. So A is the correct answer. To sum up, you get 24,500 and you get A. Number 11.
Just a question. I noticed this one is not in the negative. What if they do not retain the option? Let's say.
Okay, guys, I'm sure I told you that in the exam, all multiple choice questions or box don't put a negative sign. So what they are saying, what? Look at this question. They are saying what is the combined expense? So they know that is expense. You just write your money, the amount. Don't put negative sign. Even if, like common sense here, we are deducting expense from income. So the net amount is like this. But when you are writing the box, just write as it is. This is multiple choice. You write 24,500. Negative signs on section B if it's negative, right? Number 11. Number 11, they want the output tax. Right, when you look at the sales tax, guys, sales tax number 1, if it's theory in the exam, sales tax is an indirect tax, it's not direct. When you talk about sales tax, it's also known as the VAT, right? So this is the amount that is charged by an entity on behalf of the tax authorities, you understand? So now when they say what is the output tax, they need to know the tax that we are collecting. How do you calculate this? Annual sales of the company including sales tax 17.5, half of the sales on credit terms, half cash sales. The receivables in the financial position are 23 what? 500. What is the output tax? How do you calculate the output tax? Guys, how do you calculate the output tax? How do you calculate the output tax? How do you calculate the output tax? Yes, you can try.
I think you can use the annual sales figure.
We use what?
The annual sales.
The annual sales figure.
Yes.
So how do you do it? So how do you do it?
So the annual sales figure, you're saying there's a percentage, it's inclusive.
Yes, it's inclusive, right? So if it's inclusive, you say what, 17.5 over what? Are you seeing this? We covered this, guys. Look at this, the annual sales is 235,000, including sales tax. So this is the, they might say including sales tax. The word including, another name for including is what? They will say inclusive. Or they will say what? They will say the gross. If it's gross, it means we have not yet removed the sales tax, you understand? So, a business will make sales. And the amount they will collect, the amount they will record in the books, it will be 100%, you understand? But when they are selling goods, when they are registered for sales tax, they will add the VAT, the sales tax of how much? I mean the percentage, sorry, 17.5, right? The total, like the list price that you will see when you buy a product. If we are using 17.5 as our sales tax, the total will be out of 117.5. So this one is inclusive of what? Sales tax. This one, if it's 100%, is exclusive of sales tax. You understand? Now they want the output tax, right? Like the tax that you are collecting on sales. Our sales is how much? 235,000. You follow? So our tax, the tax that we need is 17.5 over. So either it's going to be out of 100 or it's going to be out of 1175. So you ask yourself a question that, is the 235,000 including the sales tax or it's not? On this question, they are saying our sales are including sales tax, meaning that the total has now exceeded 100%. So it's going to be out of 117.5 multiplied by the 235,000. I'm sure if you remember when we used the Kaplan book, the textbook of the Kaplan textbook, if you remember very well, we were calculating the output tax, the input tax. You just multiply by the sales. That statement is there to confuse you that half of the sales are on credit and half of the sales are cash. Whether you purchase on credit or by cash, you suffer tax. You understand? You suffer tax. I'm getting 35,000. Okay? That's the answer. Number 12, again, I'm carrying us. So, they were using, they included that information to just confuse you. Know the formulas, know what you used to do. You understand? Because if you adjust the receivables, I was curious that when did we adjust it before? You understand? So number 12, guys, what is the depreciation charge on the plant? The plant is an asset. Look at your debt. This is the tricky part, guys. People, if you don't understand the debts, there's no way you are going to get the depreciation charge correctly in the books. They are saying what is the depreciation charge on the plant in the financial for the what? Our year is ending at 30 September. That's the first thing you should do. If you don't do that, there is no way you are going to depreciate correctly, guys. Look at your year end. Our year end ends at what? 30 September 2001. Meaning it commenced on the first of what? Which month? Remember our year is how many months? 12 months. So if it ends on 30 September 2001, it commenced on one what?
October.
Yes, the 1st of October, right? 2000. That's the first thing that you do. Right. They are saying we purchased an asset. Was it during the year? Can you look at this? Is it before or within our timeline? Within, right? I'll just put in, I'll just write July here. July 2001. 2001, right? Doesn't matter if I write here, it doesn't matter as long as you know that how many months from year to year end. Right? So we purchased an asset on this day. So from 1 July to 30 September 2001, how many months do we have? Use your fingers, July, August, September, so that you get it right. So we have 3 out of 12, right? So maybe they might say we are charging full year depreciation. If they say full year, we just take the depreciation per year. Look at this. Depreciation is being charged on straight line with proportionate charge in the period of acquisition. So that's why I did put 3/12. This is pro rata basis. We acquired it at a value of 40,000. The scrap value of the plant in 10 years' time is estimated to be 4,000. Now, looking at this now, we have been given the useful life. So meaning that we are using a straight line what? Straight line method. On straight line method, we say costs less the residual value. Divided by what?
Useful.
Yes, the estimated useful life. So when you acquired it, the value was 40. Less the residual value. Guys, the residual value is also known as the what? The scrap value. So this is the value that will remain after the number of years you have estimated. You understand? So this one, it will be the remaining value, so it's not being depreciated, which is the scrap value is 4,000. the useful life is 10 years, right? So 40 less 4, 36 over 10. Then you get 3,600 per year. But this one, guys, this is not the answer. Are you seeing the solution? We have 3.6 there. This is the depreciation per year. They have said with the proportionate charge. We were going to say 3,000 is the correct if we had acquired on 1 October. When you say we are depreciating it over 12 months. But it was purchased here. So we were left with 3 months. So we need the depreciation for 3 months. So allow me to multiply by 3 out of 12. So what will be the answer now? 900, right? That's correct, right?
Yes. So they'll give you the 360.
Yeah. So guys, what I'm going to do today is I'll send you the formulas for the ratios. You understand? So you need to know the ratios. I'll send you the formulas and the audio. You understand? So listen to the audio and also be looking at the formulas for the ratios. So like on this question, this is the current ratio. Current ratio, we say current ratio, inventory days, receivables days, payables days. So I explain about that. So since I haven't covered the current ratio, I'm going to skip this one. The current assets, right? How many current assets do we have on this one? We have 3. Inventory is the current assets, guys. Receivable, current assets, cash, current assets. So our current assets, we have how many? What is the value of the total current assets? Current assets, 6, divided by the total value of current liabilities. We only have payable. Loan, guys, that loan is a long term, right? Payables is the current, payables is how much? 3. It's 3, right? Divide by 3. What should be your final answer? It's 2. Just 1. 2, like B is the correct answer. So I'll give you the formulas for the other one.